Hello, students. Before we begin today's lecture, I'm happy to announce that our website, Paperwala Hub, is officially live. For free IGCSE, O, and A-level accounting notes, Paper 1 and Paper 2 topical and yearly past papers, go visit www.adeelpaperwala.com. In the world of business, not all spending is created equal. How a company classifies its expenses has a huge impact on its reported profits and its overall financial health. So today, we're diving into one of the most critical distinctions in all of accounting: capital versus revenue expenditure. Getting this right is absolutely fundamental. Okay, so here's our game plan. We'll start with the big picture, that fundamental divide. Then we'll get into the nitty-gritty definitions. After that, we'll see how this stuff actually gets recorded in the books. And the best part? We'll apply everything we learn to a couple of real-world case studies before looking at the serious impact of getting this stuff wrong. Alright, so think about it this way. Every single dollar a business spends has to go into one of two buckets: capital or revenue. And this isn't just some boring accounting rule. Which bucket you choose determines exactly how that spending hits the financial statements. It affects everything from your annual profit to the company's entire valuation. So how do we tell them apart? Well, it all boils down to one simple question you need to ask yourself. When you spend this money, is the benefit all used up within this year, or is it going to keep providing value for many years to come? Answering that one question is pretty much the key to this whole concept. Okay, so beyond just the timing, we can get way more specific. Accountants have a really clear set of rules that outline 4 key situations for each type of spending. Let's break those down right now. On the left, with capital, you got to think big, long-term investments. This is money you spend to buy a major asset, something the business will use for more than a year, like a building or a machine. It also counts if you're spending money to boost that asset's life or make it more efficient, or if you're just getting it ready to use. Basically, anything that adds long-term value. Now, flip over to the revenue side. Think about the daily grind here. Costs for just running the business, routine maintenance, recurring stuff like repairs or repainting. The key difference? These expenses don't add new value. They just keep the lights on and the wheels turning. Alright, so we know how to label the spending. But what happens next? Where does it go? The way we treat these two categories in the books is completely different, and they end up on totally separate financial statements. And this is where it gets really important. Capital expenditures are capitalized. That's just a fancy way of saying they become an asset on the company's balance sheet, which we call the statement of financial position. They don't immediately reduce your profit. Revenue expenditures, though, they're expensed right away. They go straight to the income statement as an operating expense, and they lower the profit for that specific year. Theory is one thing, but let's make this real. We're going to walk through a classic example. A business buys a new piece of machinery. Let's apply our rules to figure out what the true cost of that asset really is. Okay, here's a list of all the different costs the business had to pay. You got the price tag, of course, but also things like import taxes, shipping, insurance, installation, even training for the employees. Our job is to go through this list and decide which of these are capital expenditures that actually become part of the asset's total cost. Let's build the true cost of this machine, piece by piece. The purchase price, obviously, that's our starting point, a capital cost. Then we add the import duties. You legally have to pay those to get the machine, so they're in. All the costs to get the asset to the factory, freight, insurance while it's on the truck, other carriage charges, those are all capitalized too. And finally, the installation and the trial run. You have to do those to make the machine work, so they're part of the asset's cost. All of these add up to build the final value. So, what about those last 2 costs? Well, employee training. That's considered a day-to-day operational expense. It's about the people, not the machine itself. And the fire insurance, that's a recurring cost to protect the asset over its life, not to buy it. So both of those get classified as revenue expenditures. So after adding up all those separate capital costs, we get our grand total, $202,500. This isn't just a number we pulled out of thin air. This is the precise value of the machinery that will now be recorded as a non-current asset on the company's books. Let's try another scenario, just to make sure this is all sticking. We're going to look at a new business owner, Amelia. She's made a whole bunch of payments to get her company started, and our job is to classify every single one of them. So here they are, Amelia's first round of expenses. We've got the big ticket items like her new office space and furniture, but also smaller things like stationery, legal fees, and even ink cartridges. Let's go through them one by one and drop them into the correct column, capital or revenue. All right, the premises, furniture, and computer, those are clearly long-term assets, so they're capital. The cost to ship the furniture and the legal fees to buy the premises are also capital, since they're direct costs of getting those assets. Same with installing the computer. It's necessary to make it operational. On the other hand, stationery and ink are things you use up in your daily operations, which makes them classic revenue expenditures. Now, you might be looking at stationery and small office equipment and thinking, wait a minute, is it a stapler a physical asset? And technically, you'd be right. But this is where a really practical accounting rule called the materiality concept comes into play. It basically says that for tiny, trivial amounts, it's just not worth the time and effort to capitalize them and depreciate them over the years. The impact on the big financial picture is just too small to matter. So we've defined the terms, we've run through the examples, but why is this so incredibly important? I mean, what actually happens if you get it wrong? Let's look at the ripple effect of just one little mistake. Imagine this. You buy a new computer, a clear capital expenditure, but you accidentally record it as a revenue expense, like office supplies. The consequences are huge. Instantly, your assets are understated, your expenses are overstated, and worst of all, your profit for the year is artificially lower than it should be. Now, when you fix that error, everything flips. Assets go up, expenses go down, and your profit is restored to its true accurate level. See, this isn't just an academic exercise. Messing this up gives a distorted view of the company. It messes up your statement of financial position by undervaluing your assets, and it messes up your income statement by misstating your profit. And that can lead investors, banks, and even managers to make bad decisions based on bad information. So if this all feels a little overwhelming, just come back to this golden rule. If you're ever in doubt, just ask yourself this. Is the benefit from this spending all used up this year, or will it last for years to come? That one simple question will be your guide to getting the classification right every single time. And that leaves us with one final thought to chew on. If a business mistakenly expenses a huge asset purchase, it's going to report lower profits and a weaker balance sheet than it really has. So how do you think that incorrect picture might affect a bank's willingness to give that business a loan for future growth? The real-world stakes of these accounting rules are incredibly high and can directly impact whether a business survives and succeeds.